You're watching today's market comment by Haralambos Pisuros. I'm Christina Marujos, and thank you for joining us at XM.com. The US dollar traded higher against all the other major currencies on Tuesday, but today it seems to be stabilizing, probably extending winnings only against the risk-linked currencies Aussie, Kiwi, and Loonie. What may have allowed traders to buy some more dollars yesterday was the ISM manufacturing PMI for July. The index improved to 46.4, and although this was still below analyst estimates, the new order sub-index came in much better than anticipated. An improving orders outlook amid the drag from higher borrowing costs translates into improving demand for goods, which could eventually prompt businesses to increase production, which corroborates the soft landing narrative. Alongside the dollar, U.S. Treasury yields also marched higher, with a 10-year yield poking its nose above 4.05 for the first time since July 10th, although they pulled back today after Fitch unexpectedly downgraded the U.S. government's top credit rating. That said, expectations with regards to the Fed's future course of action were barely changed. The data set that could make them consider another hike this year and less cuts thereafter may be Friday's jobs report for July. With most major central banks already seen ending or approaching the end of their tightening campaigns, the only one standing out is the Bank of England, which meets tomorrow. Following the larger-than-expected slowdown in UK inflation for June, investors see a larger probability for a 25 basis points hike rather than a double one. Therefore, even if the Bank of England hikes by 25 basis points and disappoints those expecting more, a hawkish message allowing traders to maintain hike bets for the coming months could keep pound dollar in an uptrend mode for a while longer. Today, the most wounded currency is the Kiwi, which came under pressure after New Zealand's jobs data revealed that the nation's unemployment rate rose by more than expected. The S&P 500 and the Nasdaq closed in the red yesterday, perhaps due to new month rebalancing, or perhaps because investors have begun locking some profits ahead of more key earnings and important U.S. data like Friday's jobs report. Wall Street finished July on a strong footing as investors cheered better-than-expected earnings, but also data pointing to a resilient U.S. economy at a time when inflation is cooling. With investors believing that the Fed has already ended this hiking cycle and expecting a series of rate reductions, the uptrends on Wall Street may be destined to continue for a while longer, unless Friday's employment report comes in so strong that it prompts participants to start drastically scaling back their rate cut bets. Oil prices extended their summer rally, hitting a fresh 3-month high due to signs of tightening supply as Saudi Arabia is expected to extend its voluntary cuts into September. This was the market comment. Thank you for watching at XM.com.